Have you ever found yourself wrestling with the idea of investing, in the stock market?
Oh, absolutely. It's a question that comes up for so many people.
Yeah, especially when you hear those stories, right? Fortunes made, smart moves, paying off, big time.
Incredible wealth, yeah. But then
But then almost immediately you get that other feeling, that counter argument. It's like a tug of war in your head.
it really is. The fear kicks in.
Exactly, the fear stemming from, well, all the crises we've seen or read about, burst bubbles, crashes.
Like the big one, 1929.
Yeah.
That history hangs heavy.
It does. So it's always this potential for great gains versus the, frankly, terrifying idea of losing everything. Well, today on the deep dive, we really want to cut through some of that noise.
Hmm.
Our mission is to give you a real shortcut, to help you get genuinely well-informed on a specific, really powerful approach to the market, and one that stood the test of time.
A method that offers a way to invest without constantly worrying you'll lose it all.
Exactly. A path to potentially build wealth, but, responsibly.
And to guide us, we're leaning on a couple of heavy hitters. First, Benjamin Graham.
The man himself, author of The Intelligent Investor.
Right. It's more than just a classic book. It's like the Bible for sound investing. And what makes Graham so trustworthy is his experience.
He wasn't just writing theories.
Not at all. He learned through hard knocks, basically. Flourished after taking substantial losses during the chaos of the 1920s. So his insights, even from the first edition in 1949, they're timeless because they were forged in fire.
That's such a good point. And we're not just looking backward. Our deep dive today brings in modern insights, too, thanks to financial journalist Jason Zweig.
Yeah, Zweig's annotations are invaluable. He weaves in that contemporary relevance, connects Graham's wisdom to today's markets.
So you get the historical foundation and the modern application. It's this blend that makes Graham's approach, well, it's why it's been used by so many to build serious wealth.
Including probably the most famous investor out there.
Warren Buffett, yeah, who calls Graham his intellectual godfather.
It's not just theory. It's a proven practice that shaped generations of successful investors. It works.
So what are you actually going to discover today? We're going to unpack some really surprising lessons, maybe even counterintuitive ones.
Like why you should pretty much always ignore this character called Mr. Market. Sounds weird, right? But it protects your portfolio and your sanity.
Definitely need that. And we'll explore why starting out with virtual money might just be the smartest first move you can make.
And this idea that sometimes the cheapest stocks, the ones nobody wants, can actually be hidden gems, most valuable finds.
So, yeah, we're about to take a fascinating journey, cutting through the hype, focusing on principles that last, what it really takes to be an intelligent investor.
Okay, let's unpack this core idea first. Our sources really kick off with a question I think everyone asks. Is investing really worth the risk?
It's fundamental, isn't it? Because you hear both sides constantly.
Totally. You've got the Warren Buffetts building empires through careful, long-term investing. Amazing successes. But then you have just as many stories, maybe more, of people who lost everything. Chasing trends, making bad bets.
It's a stark reminder. The stakes are incredibly high.
But what Graham and Zweig argue is, yes, it can be worth the risk, but there's a huge if. If you follow the strategy of intelligent investing. And that immediately draws a really bright line.
A line between what they call real investment
And what they call mere speculation.
That's right.
Profound difference. One is disciplined, analytical. The other is closer to gambling.
So let's define that. What is intelligent investing at its core?
Well, Graham and Zweig, they really emphasize one thing above all.
Which is that?
Thorough analysis, always. The goal being safe and steady returns.
Safe and steady. Okay, so not hitting the jackpot overnight.
Definitely not. It's methodical, almost scientific in a way, growing wealth bit by bit reliably.
And a huge part of that is focusing on pricing and intrinsic value.
Absolutely central. Intelligent investors only buy stock when its market price is clearly below its intrinsic value.
Okay, intrinsic value. That sounds important, but maybe a bit vague. How do they suggest we figure out that true worth?
Yeah, it's not like there's a magic formula handed down. But they push you to look beyond the daily noise, the stock price ticker.
So look at the actual business.
Exactly. Dig into the tangible stuff.
Yeah.
The company's assets, its earnings power over time, its debt levels, the quality of the management.
Their track record, can they keep making profits?
Precisely. It's a deep dive into the health of the business itself, regardless of what the market's feeling about it that day. It's fundamentals over fads.
Got it. And that leads right into another huge concept, the The margin of safety.
This is bedrock for Graham, the absolute foundation. You only buy if there's a probable gap, a cushion, between the price you pay.
And what you conservatively estimate the company's real value will be as it grows.
It's like, think about building a bridge.
Okay.
Engineers don't design it to hold exactly the maximum expected weight. They build in a huge margin, right? For unexpected stress, weird weather, whatever.
That extra strength is the safety margin.
Exactly. And for an investor, that margin of safety is your financial cushion. Your protection against being wrong, or just bad luck in the market. It's your buffer.
So it's not about the thrill of the chase.
Not at all. The margin of safety is about protecting your principal first, and then aiming for reasonable, steady returns over the long haul.
It's conservative, disciplined.
Yeah. Graham famously said something like, the life of an intelligent investor isn't very exciting.
Huh. Doesn't sound like a great sales pitch.
But that's not the point. The point is the profit. And what's profound there isn't just that it's boring, but why embracing the boredom works.
Because it stops you from making emotional mistakes.
Exactly. It disarms those traps. Our brains crave excitement, the quick win, that dopamine hit from a stock soaring.
Graham's telling us to fight that instinct, to be patient when most people aren't.
That's the real discipline. Shifting from chasing short-term thrills to harnessing the quiet power of time and compounding, it challenges our nature.
Okay, so that's intelligent investing. How does speculation contrast with that?
Night and day, really. Speculators are all about short-term gains.
Trying to profit from quick market swings, ups and downs?
Yeah, betting on fluctuations without much thought for the underlying value.
And the big risk there is, well, obvious.
Starkly simple. Nobody can predict the future reliably. Graham uses examples like, imagine hearing a hot rumor about Apple releasing some amazing new gadget.
Okay, happens all the time.
A speculator might pour money into Apple stock based only on that rumor, hoping to ride the wave.
Could work out.
Could, if they're lucky. But if the rumor's wrong or the product tanks, they could lose big. It's heavily based on chance. A gamble.
And this connects right back to you, the listener. Think about how often you hear a hot tip.
From a friend, online, maybe a headline.
Yeah, and that temptation to jump in on a stock that's shooting up, even if you don't really understand the company, it's strong.
Very strong. But Graham and Zweig say that's exactly the kind of behavior the intelligent investor avoids. It's calculated risk based on analysis versus, just a hunch or pure emotion. #2. 3 guiding principles for all intelligent investors.
All right, so we've got the dividing line, investing versus speculating. But how do we actually do intelligent investing? What are the rules of the road?
Thankfully, Graham and Zweig don't just leave it there. They give us 3 core principles, foundational stuff for any intelligent investor.
Okay, what's principle number 1?
It's all about long-term business analysis, really digging deep into the company itself.
Because the stock's value ultimately depends on the company's performance.
Exactly, over years, even decades. So you have to look way beyond just the latest quarterly earnings report.
That's a trap, isn't it? Focusing only on immediate profits.
Huge trap. Short-term numbers can be misleading. They don't show resilience or real future potential.
So when we do this deep dive, what are we actually looking for? What metrics matter?
Graham's pretty clear. You examine the financial structure. Things like the balance sheet, how much debt versus assets, cash flow, revenue growth trends.
Makes sense. What else?
The quality of the management is huge. Are they experienced? Ethical? Do they have a clear vision? And, importantly, does the company pay steady dividends?
Dividends that's sharing profits with investors, right?
Right. And consistent dividends often signal a stable, mature company that actually generates cash and cares about its shareholders. You want to look at the financial history, maybe the last 10 years, to see how it performed independent of market fads.
And doing that kind of deep historical homework is how you spot those potential undervalued gems.
Precisely. A company might be unpopular right now. Maybe its stock price is down because of some temporary issue or just market neglect.
But if it's underlying record profits, management is solid.
Then it's likely undervalued. A smart buy for a patient investor. This whole approach shifts your focus from market sentiment, which is fickle, to actual business health. That's value investing, seeing worth where others don't.
Okay, great first principle. What's number 2?
Protection through diversification.
Yep.
This is almost a commandment.
Don't put all your eggs in one basket. The classic advice.
It's classic for a reason. Graham elevates it to a survival strategy. He says, never put all your money on one stock, no matter how promising it appears.
He really drives home the danger there, doesn't he? Paints a pretty grim picture.
Oh, yeah. Imagine you've bet the farm on one company. You're sure it's the next big thing.
Feel pretty good about it.
Then, bam, you wake up, check the news. Huge scandal, tax fraud, maybe a massive product recall.
Oh, no.
Your stock value just evaporates, potentially wipes you out. Diversification is your shield against that. It means one disaster won't sink your whole ship.
It mitigates that catastrophic risk.
Hugely important for you, the listener. It's not about missing out if one stock goes to the moon. It's about staying in the game for the long haul.
Building resilience, weathering storms, peace of mind.
Couldn't have said it better. That's what diversification gives you.
Okay, principle 3. This one feels like it's as much about mindset as money.
It really is. It's about having realistic profit expectations.
Meaning, don't expect to get rich quick.
Exactly. Intelligent investors aren't aiming for lottery-sized wins. They want safe, steady revenues. Growth over time.
And the goal isn't necessarily to beat Wall Street pros.
No. The goal is to meet your personal financial needs, your goals. Trying to outperform the market often leads to trouble. Graham warns that chasing dollar signs just makes us greedy and careless.
Leads to bad decisions, rash moves.
Usually losses, yeah. So it's a lesson in humility and discipline. The reward isn't the quick, risky profit. It's the security of steady growth that builds real wealth reliably.
Patience and realistic expectations. Absolutely key.
It's a marathon, not a sprint. That's the intelligent investing mindset.
All right, let's tackle something that trips up so many people.
Yeah.
The market's moods. It feels like a total roller coaster sometimes.
It often is. And knowing how to navigate those ups and downs is crucial. Graham and his wife say the first step isn't just looking at one stock's history.
But looking at the history of the whole market.
Yes. Because when you zoom out, look back over decades, even centuries, you see a clear pattern.
Which is?
Constant fluctuation. Ups and downs are normal. Big crises, 1929, the dot-com bust, 2008 they happen. They're part of the market's life cycle.
So accepting that unpredictability is step 1.
Absolutely. And it means you need to be prepared financially and, just as importantly, psychologically.
Okay, financial prep, that sounds like diversification again. Having that portfolio shield.
Exactly. Making sure one big hit doesn't take you out. But the psychological side, that's about resilience.
Mental toughness.
Yeah. Being ready for a crisis mentally so you don't panic. Graham strongly advises against selling everything when things look scary.
Because the market recovers.
History shows it always does. Eventually. Even after the worst crashes. So, understanding that history doesn't let you predict the next crisis, but it gives you perspective on the market's underlying stability. It helps you stay patient.
Okay, so you understand market history. You've analyzed the company's history. But there's another layer, right? Inflation.
Ah, yes. The silent killer of returns. You absolutely have to grasp the difference between real returns and just stated returns.
The number you see on paper isn't the whole story.
Not at all. The numbers can fool you. Graham gives a simple example. Say you get a 7% return one year. Sounds okay, right?
Pretty good, yeah.
But if inflation was 4% that same year, your real return, your actual gain in buying power, is only 3%.
Wow, that 7% suddenly looks a lot less impressive.
Doesn't it? It highlights the need to look deeper. To ask yourself, is that 3% real return actually worth the risk and the effort?
It forces you to think about true profitability in terms of what your money can actually buy.
Yeah.
Critical point.
And this leads to maybe my favorite concept from Graham, a mental model to help navigate all this irrationality.
Okay, I'm intrigued.
He suggests we personify the market. Imagine the whole stock market as one guy. Let's call him Mr. Market.
Mr. Market, okay. What's he like?
Well, according to Graham, he's unpredictable, very moody, and not very clever.
Huh. Doesn't sound like someone you'd want managing your money.
Exactly. But the personification helps us see the market's irrational mood swings.
How does his moodiness actually play out?
He swings wildly between crazy optimism and total despair. When something exciting happens, a new iPhone, maybe, or just good economic news, Mr. Market gets euphoric.
Prices shoot up.
Way up. People get caught up, they overpay. Stocks become too expensive based on unrealistic hype. It's a get-rich-quick fever.
But he gets pessimistic too.
Oh, yeah. Just as easily. He might panic during a small downturn, tell everyone to sell, 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 even if the companies are still fundamentally sound.
So the intelligent investor needs to be the grown-up in the room, the realist.
That's the idea. Detach from the emotion. Resist following the crowd. Resist Mr. Market's moods.
But why is ignoring him so hard for most people? It feels like fighting human nature.
It is. It taps right into fear and greed. When Mr. Market's happy, you get FOMO, fear of missing out. Jump in.
And when he's miserable?
Pure terror. You want to sell everything before it goes lower. It's like he's designed to trigger our worst instincts.
A real challenge to discipline.
Absolutely. And Graham explains that when Mr. Market is happy, he makes you see profits that aren't really there. Meaning, just because a stock is rising now,
Doesn't mean it will keep rising.
in fact, stocks that have done extremely well are often more likely to fall soon. Demand inflates the price beyond reason to a kind of breaking point.
You know, it's so easy to fall for that. You see a pattern, 3 good days.
And your brain screams, it's a trend, it'll continue. We're wired to see patterns even in random noise. Psychologists show this all the time,
Our brains try to make sense of things.
which is usually helpful. But in the market, it can be dangerous. We trick ourselves. So this Mr. Market idea, it's powerful.
Because it helps you step back, detach.
Exactly. Put on your realist hat. Make decisions based on your analysis, your long-term plan, not Mr. Market's latest tantrum. It's a crucial tool for discipline.
Okay, so we've got the core principles down. Understand the business, diversify, keep expectations real, ignore Mr. Market's moods. Now what?
Now it gets personal. Because the next step is kicking a strategy that fits you, your personality, how much time you have, how comfortable you are with risk.
And Graham and Zweig lay out 2 main paths here.
That's right, the defensive investor and the enterprising investor.
Let's start with the defensive investor. Who is this person?
This is someone who basically hates taking unnecessary risks. Safety first is their mantra, and they achieve that mainly through diversification and a pretty hands-off approach.
Okay, so step 1 for them is balancing bonds and stocks.
Foundational. They invest in both.
Yeah.
Specifically, high-grade bonds, the source mentions AAA government debt, super safe
What,
stock.
lending money to someone almost guaranteed to pay you back?
Pretty much. And common stocks, actual ownership in companies. Graham suggests aiming for roughly a 50-50 split between them.
But if someone's really nervous.
He says a 75% bond, 25% stock split is okay too, even safer.
And the logic is balancing the different risk-reward profile.
Exactly. Bonds are safer, less volatile, provide income. Stocks offer more growth potential, but come with more short-term risk. The mix smooths out the ride.
Makes sense. Then, within the stock part, they need to diversify again.
Yes. Invest in big, well-known companies, solid track records, financially sound, and aim for at least 10 different companies.
10 sounds like a lot of homework.
It can be. But there's a shortcut, Graham suggests. You don't have to reinvent the wheel.
How so?
Look at established investment funds with long, successful histories. See what they hold. Align your portfolio with their proven, diversified strategies, not chasing hot stocks, but copying sensible, established funds.
Smart. And they should probably get professional help, too.
Graham strongly advises it for defensive investors. He says experts know the game better than you. They can guide decisions, keep you on track, especially if you prefer being hands-off.
So once the portfolio is set up, diversified, maybe with some pro guidance, then what? Is it just set and forget?
Almost. He recommends formula investing, or what most people call dollar cost averaging.
Ah, putting it on autopilot.
Pretty much. You commit to investing a fixed amount, say $50, $500, whatever fits regularly, every month, every quarter.
And you just buy whatever that amount gets you, regardless of the price.
Exactly. The big advantages. No emotional decisions about when to buy. You avoid putting too much in when prices are high. You avoid trying to time the market, which is usually futile.
Sounds great. Any downsides?
The discipline. Psychologically, it can be tough. What if your favorite stock plunges and looks like an amazing bargain?
But your formula says you only invest your fixed $50 this month.
Right. You have to stick to it, resist the urge to load up even when it feels like you should. That takes real willpower.
And even with autopilot, you still need to check in sometime.
Yeah, regular maintenance.
Hmm.
Graham suggests checking the stock-bond split maybe every 6 months. Are things still in balance around that 50-50 mark or whatever your target was? Have market moves thrown it off?
And consult the pro annually.
Good idea. Just for adjustments, rebalancing. So for the listener, this defensive path is about prudence, consistency, discipline, good, steady results without the drama.
Okay, so that's the defensive route. What about the enterprising investor? Sounds more active.
It is. They use a lot of the same defensive foundations, like diversification, but they have a bigger appetite for calculated risk. Not reckless risk, but calculated.
And they're more hands-on.
Definitely. More involved in managing the portfolio, which means more time, more engagement.
Do they still split between bonds and stocks?
Yes, but here's a key difference. An enterprising investor will likely put more into common stocks, aiming for higher profits, even though it's riskier.
Because they think their active management can handle some of that extra risk.
That's the idea. And they'll likely still work with a financial planner, but the relationship is different.
How so?
It's more of a partnership. The planner isn't just guiding, they're collaborating with an investor who's actively involved in the decisions.
Interesting. And these enterprising folks, are they allowed to chase those exciting, potentially high-growth stocks? The next Google.
They are, but, and this is crucial with strict limits, Graham says these higher risk, higher reward plays should be capped at a maximum of 10% of the total portfolio.
Only 10%. Even for someone supposedly enterprising. Why so strict?
It's about acknowledging reality. Even smart investors make mistakes. We're human, and sometimes Mr. Market just goes completely wild.
Unpredictable.
Totally. So that 10% cap is a safety net. It protects the bulk of your money if those riskier bets go south or if the market tanks unexpectedly. It allows for calculated risks without risking ruin.
Pragmatic, and like the defensive investor, they still need to be constantly watching things, researching.
Essential. Continuous vigilance, monitoring companies, market trends. That's key to keeping profits flowing and spotting problems early.
Now, what really defines this approach, I think, is the contrarian angle. Buying low, selling high.
That's the heart of it. It means actively resisting that urge to just trade in the market, following the herd.
Buying high because everyone's excited, selling low because everyone's panicking.
Exactly the opposite of what you should do. The enterprising investor knows trusting Mr. Market's moods is dangerous. If a stock is soaring,
chances are it's already overpriced or getting risky.
Right. Think back to the U.S. housing bubble. Prices kept climbing, detached from reality until crash.
So the enterprising investor tries to get ahead of that.
They do. They monitor their holdings. If a company becomes overrated, its price shooting up without real justification in its value, they sell before the crash.
Sell high, and then actively look for opportunities when the market is down.
Yes. Buy low. Seek out pessimism. Graham gives that great example of Yahoo buying Inktomi back in 2002.
Right. Tell us about that again.
Inktomi stock had once peaked at this insane price, like $231 a share, even though it wasn't profitable. Pure hype.
Mr. Market was euphoric.
Totally. Then the bubble burst. The price plummeted. Mr. Market got depressed. And that's when Yahoo stepped in.
Saw the underlying value everyone else was ignoring.
Exactly. They bought it for a bargain, like $1.65 on a share. Classic contrarian move. Buy when there's blood in the street, so to speak.
Wow. Powerful example. But it sounds like hard work, constantly researching, going against the grain.
It is hard work, which is why Graham says the best bargains are found this way. But only if you start smart.
And his advice for starting smart is that virtual practice year.
Brilliant first step. Before risking real money, spend a year picking and tracking stocks virtually. Use an online simulator.
What does that achieve?
So much. It sharpens your eye for finding bargains. You see how your picks actually perform without losing your shirt. And maybe most importantly, it frees you from your fantastic expectations.
Tempers that get-rich-quick hope. Shows you the reality of market ups and downs.
Precisely. Builds realistic perspective. And there are plenty of free websites for this now, so it's super accessible.
Okay, so after the practice year, you're ready to hunt for real bargains. Where do you look?
Graham says the best place is usually in stocks of undervalued companies. Ones that are temporarily unpopular, maybe facing short-term problems that don't affect their long-term strength.
Like that refrigerator company example, Enterprise B.
Perfect illustration. Solid company, good history, but hits a temporary production snag. Profits dip for a couple of months.
And Mr. Market panics. Stock price tanks.
Exactly. Skittish investors sell off. But the intelligent, enterprising investor looks deeper.
Realizes the problem is temporary, that the company will likely bounce back.
Right. So those falling prices aren't a disaster. They're a great bargain. An opportunity created by irrational fear.
But finding those true bargains, spotting the difference between a temporary dip and a real problem, that's the challenge.
It is. It's hard. It takes research, judgment, that contrarian calm. Which again highlights why that practice here is so vital. If you can do it virtually, your chances with real money are much, much better. This path offers the best potential returns. But you absolutely have to start smart and stay diligent. Hashtag outro.
So whether you lean towards the defensive path, safety, diversification, steady growth, or you feel more drawn to the enterprising approach, calculated risks, active management, that contrarian hunt for bargains.
The core message from Graham and Zweig is the same. Always walk the path of the intelligent investor.
Follow these guidelines, use discipline, use knowledge. And you really can turn your investments into maybe modest, but definitely steady and reliable profits, build real wealth over time.
Yeah, this deep dive really gives you actionable wisdom, tools to invest intelligently, see your wealth grow. But there's a final thought, a deeper question that Zweig in particular brings up.
Which is,
As you succeed, as you climb that ladder of wealth, remember that money can corrupt.
that's a powerful warning, often overlooked, I think.
It really is. And it's something the investor Guy Speier learned firsthand. He talks about it in his book, The Education of a Value Investor.
What happened with him?
He reached the top. Successful Wall Street hedge fund manager making incredible money. But he had this crisis. He realized he didn't like the person he'd become.
Felt he compromised his ethics.
Yeah, chasing success in that cutthroat world. It triggered this whole journey for him to reinvent himself as an investor and just as a person.
That's fascinating. A journey towards a more values-driven approach.
Exactly. And his story is compelling. It even includes details like how much he paid just to have lunch with Warren Buffett.
A lot, I imagine.
A significant sum, because he wasn't just seeking financial tips. He was seeking wisdom on how to change his whole approach, his character. It shows how personal this journey can be.
So the final takeaway for you, the listener, as you start your intelligent investing journey using these strategies.
Think about not just how you build wealth, but maybe also what kind of investor and really what kind of person you want to be in the process.
Are you going to get swayed by Mr. Market? Build wealth with integrity, with purpose?
It's a powerful question to ponder. Goes way beyond just the numbers.